that the value of the dollar is losing purchasing power at such a rapid rate that the fear of it going to zero is a strong possibility. And in that case, pick a number. So if you take the all-time high of 1980 that lasted in the minutes and you adjust it for the CPI, you come out with $120 silver or thereabout. If you use the metrics that used in 1980 for the CPI, not the new one, you will come out with about a $600 silver.
In other words, if you believe that there is something coming, for whatever that is, if you believe the dollar's in trouble, the markets are in trouble, geopolitically, whatever it may be, and the people that are managing your money don't, isn't that a conflict of interest? Isn't that silly? Because isn't what you're seeing globally, macro, big picture, isn't that really more important really in the scheme of things as to how it affects the markets? Gold and silver have beat the mainstream for all of these years, and they won't even acquiesce or say you're crazy.
The erosion of the dollar's purchasing power is accelerating even as physical silver tightness is emerging at the wholesale level, creating a setup where higher price projections are no longer speculative, they are structural. When adjusted for historical CPI methods, long-term indicators point to a range of $120 to $600, and today's supply behavior suggests silver can revisit or exceed those levels far more quickly than in past cycles. David Morgan, a long-established silver analyst, and Andy Schectman, a leading precious metals distributor, underline that the real stress is no longer in retail coin inventories, but in commercial bar inventories, the sector that accounts for the core 80% of global silver flow. Persistent arbitrage spreads between London, New York, and Shanghai confirm tightness in the market's deepest layer. When that layer constricts, futures-based pricing can be forced sharply higher as metal is pulled from one exchange to another to satisfy delivery demands. If shortages continue and the dollar weakens further, silver could move into a multi-year revaluation phase, with plausible upside spikes toward $150, $200, or even the $300 zone in extreme liquidity events. Once momentum breaks through the derivative ceiling, the advance can accelerate into a vertical phase. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
That the value of the dollar is losing purchasing power at such a rapid rate that the fear of it going to zero is a strong possibility. And in that case, pick a number. So if you take the all-time high of 1980 that lasted in the minutes and you adjust it for the CPI, you come out with $120 silver. If you use the metrics that used in 1980 for the CPI, not the new one, you will come out with about a $600. So where do I think it'll go? One is the market knows more than anyone. One of my favorite sayings, and yet it's true. And it keeps us all humble because no matter how good you are at whatever you do, especially in the markets, sooner or later, the market will humble you by, you have the fundamentals right, but the technicals wrong. You have the technicals right, but the fundamentals wrong. I mean, things will take care of themselves and maybe be irrational, and maybe irrational for a long time, and make you look foolish. So my guess, I would say guess, I am on record, probably without a doubt, in my opinion, I've never found this contrary, the first one to publish that silver would hit at least $100 US on this next bull market. And right now we're halfway there. So my minimum, starting in, I think, 2003, when I wrote Get the Skinny on Silver Investing, was $100. And I still stick to that. Now, does that guarantee it's going to be triple digit? And the answer is no. We could peak at 77. We could peak at 82. I don't know. We could peak at 200. I don't think anyone knows at this point. The main point, I think, is silver's run to a maximum upside level has not, I'll repeat, not been accomplished. So first of all, what is the silver? And the silver market really is a derivative. The way the price of physical silver is determined is by a derivative known as a futures contract on the COMEX, the New York Futures Exchange. And it's not even an open outcry system anymore. Basically, it's an electronic platform where there's all kinds of bids and asks for a product known as a contract for silver. And the large contract is 5,000, the mini contract is 1,000. And that sets the price. Once that price is set, if you go into the physical reality and go to a dealer such as yourself, you will see that price and you will see another price. The other price is, what is a silver round? What is a 10-ounce silver bar? What's a kilo of silver? What is that product in the retail investment side physically cost? And the answer is it varies. The premium is at times fairly low and at times very high, and depending on the product, it can be excessive. So when you buy silver on the exchange and the price of silver is, let's for talking purposes, say $51 per ounce, the only way you can get silver for $51 per ounce is in the future. You can lock in a contract at 51 and have a commercial bars on the big contract mailed to your house, to your office, to your bank, to your lawyer, wherever. And even there, it would cost you a little more than 50. You would have some storage fees from the time your check cleared to pay for the full contract. There's also some paperwork fee involved. And then in most cases, there's a shipping fee as well. So in that case, you might be looking, I'll just make up a number, 51.5. But that's very close. But what are you getting? You're getting what you called raw silver. I call commercial bars. It's the same thing. Now that product is taken to a mint, melted down, usually a little copper added to it, and it's put through a process extruding and all this punched out to make a coin. Either a government minted coin, such as a silver eagle or a South African silver crude rand or a kangaroo from Australia or whatever, or a privately minted medallion. I don't use the word coin because legally that means government press. They're the same thing really, except one's government issued, one's privately, or silver bar. And in those cases, a general market could be the $2 or $3 generally. Now, I got to go a step further. It's a set of flip-flops. We have seen congestion or tightness, or some people call shortage, in the quote-unquote silver market several times in my life, but it's been on the retail. It's been for silver eagle or 100-ounce bar, or in some cases, any silver product at all. There was a time, I forget what year, where you could hardly get any silver at all. In the retail. So the silver market, the derivatives market, was not short silver. It was the retail side that was. So they're not the same thing. They're separate markets. It's all silver, but one is 20% of the market and the other is 80%. So 20% is retail product and 80% is industrial investment, large investment demand like the SLV, ETFs, that type of thing that use commercial bars for investment, jewelry demand, even silver. This is the first time in my life that the short supply is on that side. The commercial bar inventory is so tight that there's arbitrage opportunities between London and New York and the SGE, the Shanghai Gold Exchange, or the Shanghai Futures. That's the first time we've seen that happen again and again. And that's really bullish for silver bulls and really bearish for those that are short silver. Because what that means is the main part of the silver is having tightness. And that is where the system is most vulnerable once it occurs. And it is occurring. So hopefully I explained that well, because people have been misled, in my opinion, when you hear some of the, let's say, commentators such as yourself. I'm not picking on you. I'm picking on the industry. And I don't think it's deliberate, but they give the impression that the silver market is the retail. No, that's not. That's the smallest part of silver investment. Silver's main investment is industrial and commercial activity. And that's where you want to watch primarily to see if we've got a silver issue, problem, congestion or not. And we do. And again, that's extremely bold. You might silver go from 50 to 150 in 2.5 years. So that's a 300% move in a short amount of time.
Backwardation in silver continues to reveal stress deep inside the physical market, where immediate delivery is valued more than future contracts. This inversion highlights a shift in preference away from paper positioning and toward real metal, especially as December delivery approaches and large traders decide whether to roll or stand for allocation. The tension is amplified by the December contract's size and by the growing disconnect between futures pricing and physical demand. Recent cross-border settlement tests between major trading partners further reinforce the global pivot. New payment rails now allow nations to convert trade surpluses directly into gold, bypassing the dollar altogether, settling in seconds, and avoiding Western intermediaries. At the same time, vault expansions in Hong Kong and Saudi Arabia confirm the infrastructure needed for this new settlement model. As tightness spreads across wholesale bar inventories, the signals point to a structural repricing rather than a temporary squeeze. Let's get back to the interview.
We have the COMEX options expiration in both gold and silver. And then tomorrow is the big day as far as I'm concerned. It's the large traders that are or are not standing for delivery in their December contract. And if they're not, they have to roll over their contracts or sell them, which keeps them as futures contracts, of course. And if not, they're going to stand for delivery. And And I think this is one of the big deals when you see silver in backwardation still, meaning that the cost of silver today is worth more than it is out into the future. It's supposed to be opposite of that. It tells you that there's stress and strain within the market itself, and that there's a greater demand for physical metal than is for the paper contracts that stand behind them. And this is what we've talked about for quite some time now. It's started to really come to fruition. And this is a big one here. This December contract is certainly a big one. A couple other things that caught my attention over the weekend, down again, one of which we talked about, I don't know if I talked about on your show, but talked a little bit about on others, was that the Embridge, which is kind of up from the shadows, over the last several years, the information that I would use or find to talk about the bricks was easier to find than it is now. It's kind of in the fog right now, if you will. And I think that's by design. They're keeping it quiet so as to not attract the attention of this administration and draw the cross-eyed look of President Trump. And one of the things, however, that did come to light was that UAE, United Arab Emirates, and China conducted another successful test of Embridge, a real-time test. For those people that don't remember, Embridge is the cross-border payment system that was designed by China, Hong Kong, Thailand, UAE, and of course the fifth full participant who came in a little bit later, Saudi Arabia. They're the big five, originally designed with the assistance of the BIS Innovation Hub. We talked how that went sideways when the BIS pulled out at the 12th hour. But one of the things that I find interesting, and I don't think should be overlooked, is this first trade was between China and UAE. Well, I don't think it should be overlooked that China, Hong Kong, and the UAE all run advanced precious metals markets where gold is traded in local currencies. And this enables Embridge members to convert trade surpluses, as we've talked about, directly into gold. And this bypasses the dollar entirely. This is the ultimate plan with the Shanghai Metals Exchange expansion of their vaulting system, the one that was just completed in Hong Kong. What's the significance of that? In order to take gold out of China, it has to come out of Hong Kong. So the first one was built in Hong Kong. So in an example like this, the UAE could sell oil, as an example, to China for the digitally won over Embridge, which settles in 7 seconds, 98% reduction in fees, no U.S. or Western intermediary banks, no SWIFT. And then they can settle imbalances in gold first without converting into dollars and take possession in Hong Kong. And of course, the second vault is under construction, or will be very shortly, in Saudi Arabia. This is where it is heading, and I think that's a important piece. A couple other things that I noticed, UBS, and again, these banks are so full of BS at UBS. They're all full of it because they continue to raise their price targets. And their price targets are as useful as a mud wall because they've been wrong continuously. Yet, okay, fine, and they acquiesce and raise it. So now UBS says, well, we're going to raise our mid-year price target to 4,500, previously 4,200. Well, geez, thanks. I think that these banks that continue to raise their targets, if you go back and look what they were a year or two ago, it's almost kind of laughable. A lot of people will talk about it. I don't even think it really bears much consideration at all. They really don't want people to know what their real belief is, and that's why you have, it's funny because I have an account with Morgan Stanley, and the guy that I work with, he's a very good friend of mine, and he manages, a lot of money with Morgan Stanley. He's one of the biggest in Florida, and he lives in my neighborhood. And he wouldn't know a gold coin if it fell on his foot, yet his chief investment officer has advocated for 20% holdings in gold, sell half your bonds. And so, it's to me, these banks and the people who work underneath them really have no clue. But when you're getting Michael Hartnett, when you're getting, again, another comment from Jeffrey Gundlach, the bond king, saying that 25% gold is not overweight. And then, of course, Michael Hartnett, as we've talked about, he's the chief analyst of Bank of America. They're talking to people above not the successful money managers who are managing $3 billion and are at the top of their game on retail. They're talking to the people who are bringing in all the metal into the United States. They're talking to the massive traders that are doing so, and they're saying gold and silver are being, in essence, by their actions, reintegrated into the system. In other words, if you believe that there is something coming, for whatever that is, if you believe the dollar's in trouble, the markets are in trouble, geopolitically, whatever it may be, and the people that are managing your money don't, isn't that a conflict of interest? Isn't that silly? Because isn't what you're seeing globally, macro, big picture, isn't that really more important really in the scheme of things as to how it affects the markets? And so that's the frustration that I face all these years when the mainstream poo-poos it. But if you look back at it, and we've destroyed the mainstream, right? Gold and silver have beat the mainstream for all of these years, and they won't even acquiesce. They say you're crazy. But wait, alas, you're getting at the highest level, 20, 25%. That's good, right? They never even gave in 5%, but that hasn't trickled down to the advisories yet. Like I said, my friend who is he's in the Forbes top 50 money managers in the United States in terms of the amount that he manages, and he wouldn't know gold coin if it fell on his foot. We talk about it all the time. Yeah, he's okay, fine, but he doesn't implement it at all. And his chief investment officer says, no, 20% should be in metals. The point of it is that when you have these beliefs and these feelings about being a contrarian, it's something that takes not only conviction, but it takes effort to make sure that your beliefs are right. And that's why so few people do it, Nottingham, because it's an inordinate amount of time and effort and, trust in yourself that you're right. So that's why, I think what you and I do, and when we talk about this to people, that carries a lot of responsibility. And that's why when people say you're talking your book, no, that's not true. In a world where I'm out there talking to millions of people, I'm not talking my book. I'm talking my heart and my soul, what I truly do believe. I have better things to do than talk my book and, bastardize my family name by going ahead and doing something like this that I wouldn't believe in or wouldn't recommend to my friends and family to do. So I do the work for you. I do the reading for you. And if you choose to follow it, understand that I'm only going by what I believe and what I do myself. So I don't know what brought me down that lane, but other than to simply say that I think most people don't succeed in investing because they're not able to separate themselves, A, from the herd, and B, doing the effort and taking the time, doing the effort and the work involved with formulating your own opinion. And that's a scary thing to do for most people.
The tightening across global precious metal markets is now spilling into the larger monetary arena, where settlement systems, currency flows, and gold-backed structures are redefining how value moves. As physical demand continues to outpace futures pricing, the gap between wholesale bar inventories and electronic market signals has become one of the clearest indicators of structural strain. Large traders shifting toward immediate settlement, cross-border tests bypassing Western banks, and expanding vault operations across Asia all reinforce a directional shift that is no longer speculative. It is operational. This environment amplifies every macro pressure point: persistent inflation risk, political intervention in monetary policy, and liquidity cycles that increasingly determine whether assets rise or fall together. With metals being reintegrated into high-level portfolios and global trade networks evolving toward direct gold settlement, the window of opportunity is narrowing. Markets may fluctuate, but the broader reallocation into hard assets reflects a long-term recognition that currency dilution, geopolitical fragmentation, and supply shortages are converging into the next phase of this cycle. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.